But if the gold price rises 20% to $2,160, their profit jumps to $960. That's a 60% increase in profit from just a 20% rise in the price of gold. So that's operational leverage, and it's why investors tend to buy gold miners during bull markets in the gold price. Year to date, the price of gold is up 50%. I mean, that's incredible. That's why you're seeing all the headlines on the news about the gold price. So, what is driving that? Now, there's a whole host of factors. Some of them are political and geopolitical uncertainty. So, gold has a haven status. There's also the expectation of rate cuts, particularly by the US Federal Reserve. So lower interest rates reduce the opportunity cost of holding gold. Don't forget, gold doesn't pay a yield or anything like that. There's the falling US dollar. So when the dollar falls, commodities tend to do well. So that includes gold. And the stubbornly high inflation numbers that we've seen around the world, again in the US as well, then they reinforce gold's role as an inflation hedge. Now, we can get into a debate about how good an inflation hedge it actually is, but there is a perception of that. And there's also been strong, consistent buying from central banks, especially in China, which is a source of demand. And then you've got the general speculation by bullish investors. All of those things are a perfect storm for pushing the gold price seemingly ever higher. And as I've mentioned, up 50% year to date. Now, the reason why I mentioned July is because if you're an 80/20 investor member, then you will know that each month I run my own portfolio, make changes to that. But of course, we pick a best of the best selection. So it's a short list of funds from a range of different sectors and asset classes that have momentum. And it doesn't mean they're going to keep going up, of course, but it does show that they've got momentum relative to other funds within their same sector. Now, back in July, there was a gold mining fund, so a fund that invested in the shares of companies that mine gold. And that appeared in that shortlist. Now, since that point, that fund has risen 52%. That's since the 1st of July. So that's a great example of where we caught momentum early, identified it, and no doubt people who have bought that fund are very happy about the fact that they've made plenty of money. Now, that isn't guaranteed. That isn't the way investing works. Now, my own 50K portfolio, which I also run live on 80/20 Investor, I have a core holding to gold within that. So exposure to physical gold via an ETF, and that's about 5 to 6% of the portfolio, which has performed incredibly well, of course. And it's another example of why you want to have exposure to things other than just bonds and equities. So it's just showing you that gold mining stocks have flown of late. And I just want to explain to people what they are and how they work, because it's not the same as investing in physical gold. So if you do invest in physical gold, then you are getting exposed directly to the price movements of gold. So if the gold price goes up 10%, then your holdings go up 10%. If it falls 10%, then your value of your holdings will fall 10%. So if that's physical gold or via something like an ETF, there are people who buy physical gold coins, we explained. So we talked about Britannias and sovereigns. There's the attraction of those that they're exempt from CGT. Link in the show notes to another podcast where we talked about investing in gold coins and the advantages, because it has become incredibly popular. But as I've mentioned, there are funds out there that you will notice, because they have the word gold in them, particularly unit trusts I'm talking about here, that will typically invest in the shares of mining companies. So they go and dig gold out of the ground, they manage costs, and they sell it for profit. Now, the positive is that when the gold price rises, the profits of these companies rise much faster, thanks to something called operational leverage. So to understand this, imagine there's a mining company whose cost to produce an ounce of gold, so their all-in sustaining cost is about $1,200. If gold sells for $1,800 per ounce, they make $600 profit per ounce. But if the gold price rises 20% to $2,160, their profit jumps to $960. That's a 60% increase in profit from just a 20% rise in the price of gold. So that's operational leverage, and it's why investors tend to buy gold miners during bull markets in the gold price. But the reason I also want to bring this to people's attention, because they might start flocking to these mining stocks, is there is a flip side. So those same fixed costs that turbocharge profits when gold rises can crush margins if prices fall or if inflation pushes up their costs. So there is this kind of double whammy that goes on. So mining is expensive. There's energy costs, there's the cost of labor, and of course there's compliance that all can eat into profits. So while miners can outperform gold spectacularly in good times, they can also underperform just as spectacularly when conditions turn. And as I've mentioned, that isn't just if the gold price turns and starts to fall. It could be down to the cost rising exponentially. So mining gold is a risky business. So is investing in gold mining shares. I mean, I've mentioned these operational risks, but there's also risks like accidents happening that could shut down production. And then you've got things like geopolitical risks. So many mines are in unstable regions and governments can change the rules, impose taxes, or even seize assets. So all of these things make gold mining shares very volatile. And a miner, say in Australia, faces very different risks from a mining company that's operating somewhere else, maybe in Mali or Mongolia. So you've got to bear that in mind. So gold mining shares are risky if you invest via a fund, and there's a number of them out there. Now, I'm not going to tell you the fund that was identified by 80/20 Investor. If you want to know, then you can go and take a free trial. We'll put a link to the notes of this show so you can go through and have a look if you wish. But there are a number of unit trusts, for example, that specialize in investing in gold miners that will look at a range of companies to try and diversify the risk. So the message from this part of the podcast is that gold mining shares can be attractive. People will probably be looking at them more and more now the gold price is going up. What they'll do is they'll go and search, maybe it'd be Hargreaves Lansdown or whatever platform they use for gold, and they might find those unit trusts, but it's not gold, it's gold mining shares. You need to understand the difference. If you want exposure to gold, then you physically own it or do it via an ETF. You can get physical ETFs in particular. Because gold mining shares are just that, they are shares. When stock markets fall, they can get caught in that downdraft too. So even if it's nothing to do with the price of gold or what's going on, if stock markets fall, then it can also drag down gold mining shares. And interestingly, physical gold doesn't tend to correlate in the same way. So sometimes when you get a bout of risk aversion, gold can do quite well. Now, that's not strictly true. If you go back and look at some of the periods in time, like the financial crisis and even the dot-com bubble, when that burst, we still saw gold fall. So it isn't a case that if stock markets fall, gold goes up. So I don't want people to think that. So to wrap this short piece up on gold miners, there's been some incredible returns that people have achieved on gold mining shares. But it means that people, if they understand what they are, they also understand the potential risks, because we have seen some crazy movements, almost exponential this year, partly on the back of the gold price. I mean, that's been a biggest influence, in fact. So bear that in mind. If you do your own research, look at what's out there. But if you are interested, of course, then you can see how I invest in gold via 80/20 Investor.